to know where's hot in Melbourne moving into 2025?
We're looking at Melbourne because of the incredible value there. There's good buying opportunities.
Why don't we talk about the first cab off the rank?
This episode, we unpack 7 of the 22 areas across 3 different categories: 500,000, 800,000 and above $1 million. And one area that's more of a no-go.
There's a booklet down below. Click the link. You can download the whole thing for free.
The disparity between Sydney prices and Melbourne is like a 41% on house prices. It's over 20 years since we saw this gap.
And the man behind this list is self-made millionaire Steve Ash, former investment banker and now buyer's agent, who brings a lot of his investment banking skills over to the property space.
For me, Broadmeadows, the numbers just make a lot of sense.
Got pretty decent proximity to town. That sort of 570 median house price.
The house prices in Werribee are in the low 600s to mid 600s. Yield here is actually very strong for Melbourne.
Yeah.
Vacancy rate is 0.84%, so it's a very tight market there. The actual rent growth is 23.69% over last year, which is quite incredible. The next area is
This is a bit of a controversial one. This is making some people's not lists, some people's hot lists. It's a real divider. The thing that surprised me the most is your no-go area.
I think there's an issue with the data here. It's actually
So whether you're looking for low budget value adds, stronger yields, or maybe some top end capital growth plays, if Melbourne's what you're interested in, this episode's for you. My name's Todd Sloan. This is the Pizza and Property Podcast, and you're listening to my chat with Steve Ash.
Steve Ash, pleasure to have you back on the show, man.
good to be back. Thanks, Todd.
And we're going to go through a list of, I want to say, and I've said on the show before, the sleeping giant. I feel like the giant is starting to wake from the slumber a little bit. And you've got a list of 22 areas that we're going to be going through that you've categorized in a pretty cool way, I think, man.
Yeah, I think so. A sleeping giant might turn into the iron giant. Like, that's one for my son just quickly, but no, because he loves that, but all good. No, we're looking to sort of categorize this into 3 areas because we know that there's different, some of your listeners are different types of investors. Some are more sort of cash flow sort of play, some looking for more capital growth areas, and then some looking more for some value add reno at top end. So we're going to split this into 3 brackets, one around 500k plus mark for your cash flow, 800k plus for capital growth, and then 1 million plus for sort of some value add capital growth play as well.
And now just to clarify, when you say 500k plus and it's cash flow, we're talking the best cash flow for Melbourne, not best cash flow in general, correct?
Yeah, we're not talking West Sydney in 2010 where we're getting 7% yields. We're probably looking, 4.5% yield, which is good in Melbourne, but we'll go into a little bit more why that's good and what's happening. That's right.
Like you kind of high-fiving if you're cracking over a 5% yield right now.
Yeah, I don't think I ever remember yields this high in Melbourne. And okay, I've been in Australia close to 20 years, but generally the rule of thumb was around that 3% mark. So anything over 4 is pretty good going.
The thing that surprised me the most is your no-go area, because not only are we going to unpack 2 areas out of all of these, and there's a full list of 22 different areas that there's a booklet, again, down below, click the link, you can download the whole thing for free. But there's one area that you're going to go through, it's a no-go, which was a big shock to me because at first when you said it was a no-go, I was like, no, you got the wrong area. Then you unpacked it, I was like, I get it. So stick around for that because that's a very interesting one. Yeah. But is there anything else that you wanted to chat about before we get into the first suburb?
Yeah, we had that panel a little while back where we actually talked about the growth play with Melbourne. And one thing I just wanted to call out at the moment, this disparity between Sydney prices and Melbourne is like a 41% on house prices, which I think is the biggest it's been in 20 years or so. So anyway, the point of just mentioning that is really the value proposition in Melbourne. Even from whatever way you want to phrase it, a mean reversion, etc. Like we know that this is a bit of a cyclical play, so we're looking at Melbourne because of the incredible value there, and hopefully we can sort of add a bit of value ourselves by going into some suburbs where I think it's worth a bit of further analysis. So that's setting the scene a little bit, and I just want to call that.
And it is crazy different now, isn't it? Like you're more of a stats and data man than I am. Like this isn't the kind of thing that's happened for a very long time, if at all.
Well, no. It's, as I said, it's over 20 years since we saw this sort of gap, and obviously Sydney's had decent growth in there. But I think it's just important, as we talked about before, that Melbourne's prices have been pretty flat in that time, and some of these suburbs we're going to talk about really just haven't grown that much at all in the last even 10 years. And if we again history, sort of like we look to the history to look at future trends, and what have we got with Sydney West didn't move in that preceding period from 2010, and then it had a good time from 2010 onwards, and we all know about Brisbane in that 2010 decade, and then same with Perth, and then look what's happened there. So I think Melbourne's shaping up again. No one's crystal ball. No one knows what's going to happen in the future. It could be a few years before this plays out. We know there's there's items at play with Melbourne that are restricting growth there. But
yeah, it doesn't have the friendliest political landscape for investors, let's be honest.
No, it doesn't. You've got the tenancy laws and the land tax rules that have just come in. There's so many reasons why not to invest, but those are the reasons why you should be looking. And hopefully here we can unpack some good areas for you to sort of start and look at and put at the top of your list and start, prospecting, if you will.
Well, I know this isn't in an order of like your favorite to least favorite, but why don't we talk about the first cab off the rank, which I believe we're starting with your 500 plus, correct?
Yeah, starting with 500 plus.
What's the first area?
First cab off the rank. So I'm just going to refer a little bit to some numbers here because I don't have that photographic of memory, but we're going Werribee.
Werribee. Okay. Why Werribee? Actually, no, first before I get into the why, what are some of the quick numbers? What are we looking at median house price wise?
So house prices in Werribee are in the low 600s to mid 600s, around that sort of mark.
All right, and what are we looking at like yield wise?
So yield, we're close to 4%. It's actually 3.94%, so that's pretty decent.
Okay, so almost a 4% yield. And so that's the median yield, like average yield?
Yes.
Okay, so again, like you could pick up something that's in that higher fours and like potentially.
And this is for houses, not just units. So we're just purely looking at houses here. So I should add, so every sort of asset class we're looking at here is houses at the moment in the hotspots for. And
gotcha.
So numbers, so don't, this isn't mixed up with units at all. This is purely
all houses.
Freestanding houses, yeah.
All right, easy. What are the stats you got?
So vacancy rate at the moment is 2.15%.
Okay, that's a bit high.
Yeah, it is, and we're quite used to sort of historicals, especially in times like around that 1%, but it is trending downwards at the moment, which shows it's just getting a bit of a tighter market there.
Okay, so it's going in the right direction.
Yeah, it is.
Okay, easy. And so we're looking around 650, 4% yield, vacancy rate 2.1. What other kind of stuff? Do we have some like stock on market numbers or anything else like that?
Well, look at the sort of percentage of renters. So it's 36, so 64% owner occupiers. So that's fairly healthy for the area, especially in Melbourne. And then, but importantly, we're seeing rental growth in that sort of time period of 17.5. So that's some appreciation there. So we should see those yields start to tick up depending on what the price does, of course.
And is that really what's pushing this? We're seeing like 17% rental growth, but if you're, and I'm pretty sure you've got this stat as well, what are we looking at for our price growth stats though? Past 12 months?
Yeah, so price growth, we're looking at 1.72%, and just a minuscule sort of like lift.
So basically nothing. And no. But we've got 17% rent growth.
Yes.
This is what's fixing the yield.
Yeah, exactly. Right. Exactly. And, it's just catching up. All of that time of no growth and then rentals coming up. And, again, we talked a second ago about crystal balling, but Melbourne's quite an unfriendly sort of landscape for investors at the moment. So it's quite possible more investors will leave the market and obviously less supply, and we could see more pressure on those rents coming up.
Yeah, that makes perfect sense, man. And now for anyone that's a little bit newer to investing as well, 64% owner occupied. What's like a tipping point for you when you're like, oh, actually, no, that's probably not enough owner occ?
I'd say generally over 60%. Yeah, again, we can't compare sort of like cities, and Melbourne's always had a bit more of a renter base than sort of some of the other cities. So in Brisbane, for example, we're seeing that would be, say, 70%, but I'd say 60% from what I'm seeing is pretty decent sort of areas to look at, yeah.
All right, so apart from the stats side of things for Werribee, why Werribee?
Yeah, so Werribee's 29 k's to Melbourne, so that might sound like a long way, but there's a fast train that goes there, so it's roughly about 45 minutes on the train.
And where are we again? We're north?
So we're west.
West.
Direct out west.
Yep.
So it's fairly close to get in. A couple of items going on. You've got the hospital upgrade there, so it's going to create a few jobs, which is good. We've got the zoo expansion going on there.
Did you say the zoo expansion?
Yeah, I'm trying to think, and yeah. I'm going to say I'm Steve Irwin, but I do like my zoos, especially taking my son there. But no. So that's going on there, which is nice. And it's also in that position where it's not too bad to get down to Geelong and the beaches, so it's quite a nice position. And and sort of like the houses that we quite like are trying to get as close to the station as possible. Still getting this older style properties on decent land, some with development potential. So there's a lot in there to keep an eye on, and with a decent sort of yield, do quite well over the long run.
Okay, so we're looking at the stats are really pointing in the right direction as far as rent growth is going up. There hasn't been much growth for price, which again, that's how you look at this, but that's the whole Melbourne debate right now anyway.
Yeah.
There's infrastructure investment going on, upgrading the zoo, the hospital. There's a bit of money being spent in the area.
Yeah.
But it kind of sounds like this is more, if anything, it's the value play for you. Are you looking at this like 600, 650, like it's looking good value?
Yeah, no, indeed. I mean, the infrastructure play is obviously great. You've got the train line from Geelong as well. I believe there's some upgrades going on that line there, but it's really It's cheap, it's easy to get in, and it's a nice suburb. There's good schools there, and I see there's just good long-term growth potentially there.
Okay, love it, man. Anything else you wanted to talk about with Werribee before we move on to the next one for 500 plus?
No, I just think to your intro, it's going to be interesting to talk about the last item. But no, I think that's a good start. We're got some runs on the board, so that's Werribee done, and we can go to number 2.
Perfect. What's the next area?
The next area is Broadmeadows.
I feel like this is a bit of a controversial one.
Yeah.
Because this is making some people's not lists, some people's hot lists. It's a real divider. But let's talk some quick stats first.
Yeah, sure. No, I totally get it. And it's one of those divisive things. We go back in time, we've got Logan on the list and maybe sort of Mount Druitt in Sydney. So let's get into the numbers. So the median house price there at the moment, probably need some glasses, but it's 570,000.
And what are we talking about for yields?
So yield here is actually 4.29% on houses.
4.29.
Which is very strong for Melbourne.
Is this one of the strongest, if not the strongest?
It would be up there. I can't think of many stronger than this, especially this close to Melbourne. All
right, so how far are we for Broadmeadows from town?
So just 16 k's, and that's northwest. 16
k's northwest. I always thought Broadmeadows was a little bit further, like 20 odd k's out. So that's not far at all.
No, it's not. Okay. And there's a train line there as well, so it's good transport. It's easy to get into the CBD.
All right, so good public transport. We've got pretty decent proximity to town.
Yeah.
Around that sort of 570, 600 sort of median house price, 4.2% yield. What are some more facts on this one, mate?
So it actually gets a little bit better and more compelling as a sort of like investment case. So the vacancy rate is 0.84%, so it's a very tight market there.
Heaps tighter than Werribee, what you were just saying before.
Yeah,
okay,
yeah,
and trending down, going up, stable. Where is it sitting?
It's trending down.
Trending down. Okay, so it's getting even tighter.
So it's getting tighter. Yeah. But this is the interesting thing. So while it's trending, what we're talking about Werribee, there's high percentage of owner occupiers there. In Broadmeadows, there's more sort of rental, or it's not as strong a ratio. So here we're kind of looking at 47% owner occupiers.
47%. So it kind of goes out of that 60% that you'd like to see. But so why is it still making the list though? If it's that little bit, is it just it's got so much value potential, or what are you kind of looking at that goes, I'm okay to put that concession there?
Yeah, okay. So it's obviously proximity to the CBD, low vacancy rate. The actual rent growth is 23.69% over last year, which is quite incredible.
That's massive.
So we're looking at a higher rental yield, depending on what obviously price does. So again, we're talking about yields in Melbourne at the top of the call. There's obviously good opportunity here.
What's price growth done? So 20 for rent. What about capital?
So capital growth 3.64%, which isn't too bad really for Melbourne and a suburb in Melbourne.
Yeah.
So, and it's no detraction, sorry, to Melburnians or anything. It's just...
but it's purely investment. You're talking about this in comparison to what we've just seen in Adelaide, Brisbane, Perth.
Yeah, exactly.
3.4% seems laughable, but in its own right now, when we've just talked about Werribee at 1.7%, not bad.
With sleeping giants, we're talking, exactly. It might be waking up here, so it's pretty compelling. And the other thing I'd like to add about Broadmeadows, there's decent plots of land. There's lots of houses where you can put value add and sort of simple cosmetic reno, sort of paints, paint the wall, paint the house, I should say, carpets, etc. And you can actually add in a bit of sweat equity if you can. And there's quite a good opportunity in Broadmeadows there. There's pretty generous zoning. There's quite a few properties there where the house is set to the front of the block and you can subdivide and build at the back. So there's lots of value add there. So it ticks a number of boxes on how you can actually add value to the property with a decent rental return and potentially good organic growth in the future.
Broadmeadows sounds like it's ticking a few boxes there. So and it's slightly cheaper as well. Not by much for Werribee, but a little bit.
Just a little bit cheaper, yeah, but it does tick a lot of boxes, yeah. And it's in a lot of people's price brackets, so there's obviously, a lot of people, it's very affordable, and so it'll factor into a lot of budgets, and that'll obviously, when people do start looking at this area, more demand, more, will spur those prices on. So
if we were comparing these two, as far as like demographics, which one would be your kind of pick of like, now this is potentially more like a more solid area, nice area, or are they like they're pretty much identical?
It's an interesting one. So if you had my wife and myself in a room, she really likes Werribee, and she obviously works in property strats and looks at a lot of the deals there.
Yep.
But for me, Broadmeadows, the numbers just make a lot of sense. There's a lot going on there. I just don't think you can go wrong holding that yield. Land banking, there's development potential. If you can buy close to the station, there's zoned areas where you can put townhouses units on there. So I certainly think there's opportunity there just to buy those assets and land bank, and you'll do very well over the next 10 years.
Love it. Is there anything else you wanted to talk about with Werribee or Broadmeadows in the 500,000 plus range before we move on to the 800,000 plus?
I think one of the things I wanted to mention, I mean, these were the two sort of picks, but we've got a few other sort of other suburbs in our report. There's a number of areas still around Melbourne with similar sort of characteristics as these two.
Mm-hmm.
So, but just wanted to call that out. There's other areas there, the likes of Deer Park, Dallas, etc. So great opportunity, but these two are just caught the eye a little bit. So I just wanted to talk through them today.
How many more you got on the list around that 500?
That's a good question. Yeah, we've got about 7 around that mark.
Another 7 on there. Okay.
Yeah. And that just goes to show the value in Melbourne.
Yeah. Okay, so these aren't just like one-offs.
No. And again, we'll get onto the other ones, but someone like Epping is just a quick teaser. It's a good one as well, where there's a lot of infrastructure spend going on there, but there's obviously a little bit more in the report about that.
Gotcha. All right, man. Well, why don't we move on to 800,000 plus? Now, this is for someone that's looking for more of a capital play. And I like, we've talked about this before. This has got more to do with like, you're okay with holding a bit more negative gearing. Like you're certainly not doing this for cash flow, but you feel that there's enough potential growth in these areas to really enjoy some capital growth, correct?
Yes, correct. And got a couple of interesting suburbs to talk through here. And the first one here is Heidelberg West.
All right, and what are we looking at for median house price for Heidelberg West?
So median house price, we're looking at about that mid 700K mark.
And not vacancy rate, yield?
So yield here, it's actually not too bad. It's 3.62%. Again, it's not competitive to other cities, but still not too bad.
But it's not crazy lower, like in compared to Werribee and Broadmeadows that we just talked about. So
No, it's not. It's not. And I think it's again that proximity to the city and then the suburbs where it's pretty close to. So that probably accounts a little bit to it.
How about vacancy rate?
Vacancy rate's fairly tight. It's 1.99%.
1.99%. Okay, so still on the higher side in comparison.
Yeah, it is a little bit. Yeah.
But I'm going to guess that our owner-occupier percentage, though, for Heidelberg West is a little bit more in the owner-occ sort of favour rather than the renter favour. Would I be right in that guess, or would I be wrong?
You're actually wrong. It's
really?
Okay. No, and we'll talk through the capital growth play in a second, but it's actually only 42% owner-occupiers in this list. I know that goes against what I was saying a few minutes ago, but it's just really the location of Heidelberg and where it is and the price points, and there's reasons for this. Actually, we can get into it in a second.
I was going to say, let's finish this part and then let's jump into the reasons behind it, because I know you've got some solid reasons behind it.
Yeah.
What are we looking at we've got vacancy rate. What about our capital growth?
So capital growth on the year is 1.74%, so hardly grown at all. But the other thing I just wanted to touch on, just in the rent has grown 25.7% in the last year. So seeing a bit of appreciation there, which should sort of transfer quite well.
25.7%. That's the highest on the list so far.
Yes. And again, it's a tightly held suburb and close to CBD, etc.
So really, if we look at this with a median house price of like mid sevens, 25% rental growth, but if, what was it, 1.7% capital growth?
Yeah.
If we were to have this or make this episode this time last year, we would have been talking about an area that had like a 2.8% yield, 2.5% yield?
Yes, exactly. So there's been appreciation. So it's making it obviously easier to hold an asset in there. I know we're talking about capital growth in this, but again, that's just a bit of a sweetener if you can find that good deal in this suburb.
Absolutely. All right. Is there any other stats you wanted to talk about before we get into a little bit more deeper about the why?
Just quickly, I mean, it's not really a stab. I just wanted to just to confirm, just for people out there, Heidelberg West is at 12 km. Is 12 k's just northeast of the CBD.
About 12 k's northeast. Okay, so we're the closest so far, but we're also, I was going to say significantly higher, but it's not significantly, but it's definitely more expensive.
Yeah. Exactly. It's still not a bad price point, but yeah. But the kickers to the why, what we're talking about, is really just that location. So it's surrounded by a number of blue chip style suburbs. So it's sandwiched between your likes of Preston, Ivanhoe is a little bit south of the mark, and then Heidelberg Heights, and all the sort of median prices there around that sort of, like take Preston 1.1 up to Ivanhoe, which is 1.6, and obviously you're comparing Ivanhoe and Heidelberg West is, sort of, they're obviously not the same suburb, but still they're so close together and there's such a disparity in prices. So with property investing, we always look at the ripple effect and kind of looking at these sort of pockets that are undervalued. And there's reasons why the price at Heidelberg West is maybe a little depressed compared to these suburbs. There's pockets you need to just be wary of where you invest, but still, like, there's good value play again. Similar to Broadmeadows, there's good zoning areas there, sort of in the residential growth zone. Good opportunity to buy property there, maybe not with such a good yield, value add potential, long land banking sort of play. So I just again, this ticks quite a few boxes for me. If you can find a good, maybe it might be the worst house on a good street, and just hold that, sort of see if you can just spend a bit more money and get a bit of uplift.
And so you're basically looking at this from the level of everything around it is almost like $1 million plus suburb. This is the one that's sitting here, chilling at around the mid sevens, and you're like, it doesn't make sense. And whilst there might be some pockets that maybe aren't as desirable as other pockets of it, it's got some pretty well-to-do friends around it.
Well-to-do friends, indeed. And if we look at that macro level, strong suburbs around there, but micro drilling in, it just means you might be able to snag a good bargain, sit on that. And we have been waiting for gentrification for quite a long time, but it's a good long-term play is what I'm saying.
So was Preston, though, for a long time, though. Wasn't Preston very like, oh, Preston, why are you buying there? And now it's like, oh, Preston, that's not bad.
Well, yeah. I mean, when I started investing in Melbourne back in like 2011, like Preston was one of the areas that we were looking at, and that was around 600,000. Then that was like for development type blocks and pretty close. And that, as we just talked about, like the median there is now 1.1 million. So something like Heidelberg, so close. Yeah, obviously Preston's, like you said, you had the markets there, but Preston's done really well pretty well over the last 10 years, and I think Heidelberg West is an area to watch. And if you've got a bit of money to spend, just it's worth a look.
Love it, man. Anything else you want to talk about with Heidelberg West before we move on to the next area over 800?
No, I think it's quite timely talking about Preston, because the next suburb is actually quite close to both of these, and it's Reservoir. And
Reservoir.
We can talk about that one too.
Let's start. What kind of prices are we talking?
Yeah, sure. Okay, just one second.
More expensive or less expensive than Heidelberg West?
It's going to be more expensive.
Yeah.
And one thing, sort of like just to be aware, Reservoir is a massive suburb. There's many different pockets, and there, so it's going to be an interesting meeting that's comprised of quite a few areas, and similarly, there's areas just to avoid, so just do your due diligence when you go there. But the Reservoir is in the high 800,000s.
High 800. You know what I just realised as well? So if we're talking like, 80-ish, something like that? But Heidelberg West was 750, and this is supposed to be the 800 plus category. So we've got extra bargains there.
Well, exactly. And I'm sure there's some people listening saying Heidelberg West, well, why would I go there? But there you go, exactly. Like, we've just gone straight into the next suburb, which is even further out. And it's already a little bit more.
And so Reservoir, if we're talking around that kind of like $900,000 mark, is that's getting you something like pretty decent as well, like the decent block of land, or?
Yeah, well, you're still looking around that 600 square meter sort of area. There's a rule of thumb, like anything, it could be anything from 500 to 800, but again, good zoning rules there, and pockets where you can put, again, in the residential growth area, where you can put townhouses, apartments, etc., where you can look for, or the general residential zone where you can actually, again, look for subdivision potential. But again, just looking at more of a nicer suburb to be in, and one that's been gentrifying slowly as time's gone on.
Okay. What are some quick stats on Reservoir?
Yeah, sure. So the yield here is a little bit lower, as we'd expect. So it's 3.11%.
And vacancy rate?
So a vacancy rate's 1.31, so quite tight.
So vacancy rate, 1.31. Is that trending downwards? It's stable? Where are we?
Well, actually, it's trending down in the short term at the moment, but about a year ago, it was actually a really tight market around that 0.58% mark. So It's ticked up a little bit. It's still fairly, anything under 2 is generally pretty tight market. So it's obviously ticked up. Looks like it's coming down a little bit again, but yeah, that's one just to keep an eye on.
I feel like we're so used to seeing vacancy rates now of like 0 point something that 2 seems crazy, but it's like, no, 2's actually not bad.
No, it's not too bad. Another sort of comparison, I mean, just to go to a different city just quickly, but during like the mid 2010s, like Logan, for example, was up to 7% at one point. And then obviously what's happened now, we're kind of looking around that 1%. So anything, rule of thumb under 2% is pretty tight market.
Yep. Okay. All right. So our vacancy rate is up a little bit higher, sort of went down. Sorry, it's gone up a little bit, trending back down again.
Yeah.
Where are we talking for our growth, rental growth?
So rental growth is pretty strong, not as strong as the other two, but still 14%.
40% is still good though.
Yeah, exactly.
It's nothing to be sneezed at.
You know, there's a time where, as a landlord, you didn't see any rental growth at all, barely any. So it was flat till the COVID years. So yeah, it's still pretty decent, nothing to be sniffed at.
And our capital growth?
So capital growth in this area is 3.8% over the last 12 months.
So this is actually the highest on the list so far.
Yes.
3.8%. And okay, so and is this leading us a little bit into the why? Like, do you think that it's starting to be recognised as the value that you're seeing it?
Well, I think, again, and it's a various theme so far during the pod about sleeping giants. I mean, Reservoir, the prices have ticked up a little bit, but they haven't actually grown too much over the last 10 years or so. And there's some really nice areas in Reservoir. We're talking about some areas to avoid, but even that pocket on the border of Preston, just lovely. To the west of Reservoir, there's some lovely parks out that way, lovely houses. Yeah, so you've got some areas there. You've got Northern Shopping Centre, which is massive. It's a good place to go. You've got Summer Hills as well. So there's quite a bit of infrastructure there. There's a couple of good schools there as well. So the other thing is that, again, it's another similar sort of theme. You know, houses on decent plots where you can add value to. Yeah, buy as close to the Preston border as you can, sort of value add potential, and I think you'll do very well out of this suburb.
And how far away are we from the city? Like Reservoir is pretty close, isn't it?
Yes, it's pretty close, Todd. It's 12 Ks.
Okay, so 12 Ks as well. All right, so we're looking awesome proximity, definitely a bit higher than Heidelberg West. But if we're talking the strongest growth so far that's been on the list, but the yield was actually, do we talk about the yield? What was the yield?
Yeah, the yield
3.1.
Yeah, 3.1.
Yeah, 3.1%. Okay, and 3.1. So it's the lowest yield on the list, but again, this isn't your yield play. This is it's surrounded by other, like, again, it's got the expensive friends sitting around it.
Expensive friends, yeah. It's a nice suburb, yeah. And there's obviously pockets which are a little bit cheaper in Reservoir where you potentially can go in and maybe get a little bit of a better yield.
So before we get into the value add side of things, Steve, is there anything else you wanted to wrap up with Reservoir?
Well, yeah, sure. The other thing we didn't call out is you've got La Trobe University there, which is bringing international students, which is obviously good for that rental appreciation as well. So, yeah, so there's that as I said, good shopping areas. So I think all of this makes Reservoir still a compelling sort of like investment opportunities for those looking for capital growth again in the long run.
What's your thoughts on like the rooming house side of things when you're that close to it? Because I'm kind of neutral. I'm not a fan of it, but I'm not against it. I've seen some people do pretty well, but I'm a bit cautious. Are you similar, or where are you on that one?
Yeah, well, I mean, it's not my bag really, but just to let you know, when we were kind of looking at development there, one of the reasons for doing that was to sort of take advantage of that and trying to rent the rooms out for students and just to develop townhouses where it might be 4 beds, so you have 2 upstairs and 1 downstairs or whatever on 3 levels to sort of like do that separation. But then obviously COVID hit, so that changed it. So it's not a strategy I look at personally. So I'll leave that to others to sort of like opine on that.
Okay, fair enough, man. And so the value add section. Now, there's 2 areas here that I think this is going to be really interesting. So this isn't necessarily if you want to flip, add value, or if you want to renovate and hold, add value, because some of the yields here are going to be very difficult to hold for the average punter. But again, when we're talking about that disparity, and this is one of the things that I really like about the way that you look at property, Steve, and the way that you pull your investment banking background, you're looking at this from a way of like, you can potentially make some huge uplift, whether you live in it as a PPR and tap into it as equity, whether you do end up renovating and selling, whatever it is.
Yeah,
there's options here to really take advantage of some discrepancies in price.
Yeah, there is. And actually, you know, the surprising thing is the rental yield aren't too bad in the first suburb we'll talk about, but yeah, it's exactly value add. And again, in areas prime for growth. So the first one we'll talk about is Chelsea. Which is Bayside, southeast.
Okay, and how much are we looking at in Chelsea?
So Chelsea, the sort of medium price is around that $1 million mark.
All right, around the $1 million mark for Chelsea.
Yes.
Okay, so $1 million, and we're looking like what? Just a bit under, just a bit over.
Yeah, just a bit under.
Just a bit under. Okay, so $1 million for Chelsea, and you said the rental yield's not that bad.
No, it's not that bad. It's actually 3.29%. So
that's better than I thought it was going to be.
Yeah, it's obviously that proximity to the beach, and but again, it's obviously a long train line from the CBD all the way to Frankston. That's more towards Frankston, this particular area, but good suburb, good restaurants, nice beach area. So yeah, I'm going for it.
Do you mind if I skip straight to how far from the city?
Yeah, so how far from the city? It's actually 30 Ks from the CBD.
Okay, so we're getting more expensive, but we're getting further away.
Yeah, but Melbourne works very differently. A lot of the value is on the southeast, and if you think Bayside all the way round, so city out to say the likes of Mordialloc, which is about halfway between Melbourne and Frankston, and you'll sort of see value all sort of gradually decreasing the further you go out, but still good value, obviously, because it's quite easy to get into the CBD, but you've got that obviously close proximity to the water.
I don't quite understand this, because this has always felt like it's a little bit of a like Hamptons for Melbourne. It's like it gets cheaper, then heaps more expensive. Like Bianca and I were looking the other day.
Yeah.
We're looking at these like 10 mil homes, and then you walk down the road a kilometre and all of a sudden they're like $1 million. You're like, what happened there?
It's a good call out. So you've got Frankston obviously right at the bottom of there, which is probably the lowest price. But then when you go out to and Frankston's a great area, and it's probably worth talking about in another podcast, but Frankston's really in that sort of that gateway to the Mornington Peninsula. And so around about the Frankston South area, it's just lovely houses there. There's an amazing high school zone there. But then you go into the likes of Mount Eliza and Mornington. And Mount Eliza, if you're Bayside, the other side of Nepean Highway, you've got some house prices in the tens of millions, because you've got that. It's a lovely suburb. There's a village feel to there. It's an interesting one.
I just can't think of another area like it. I think that's why it got my attention, because when I think of Adelaide, can't compare it. When I think of Brisbane, and I don't know Brisbane as well as you do, but I can't compare it. I can't see somewhere where it just goes down, boom, and then back up.
I think the Hamptons is a pretty good sort of like analogy, because it's all right. And if you look at the Mornington Peninsula, for example, it goes down a little bit from Mount Eliza, or the house prices, I should say, go down from Mount Eliza more towards the middle of the area, and then you obviously spike out as you go to Portsea, Sorrento, and then Sorrento is very close to the Bellarine Peninsula. So there's I've looked at prices a lot down there, and they've obviously done very well through COVID. There's talk of maybe a second wing market in the peninsula doing well, but I still think if we go in just that bit closer and we look at Chelsea, the reason why I really like it is that value add you were just talking about. So
talk to me more about that, because I feel like I've already derailed us a little bit. No. So what are you really seeing there in Chelsea with that potential?
Yeah, so again, we've talked about this in another slice, but if we look at the median price for sort of three bedders at the moment, they're around about that 900k to $1 million mark. Now, the sort of median price for four bedders is 1.5 million.
Okay.
So if you can find maybe an old house, you're talking like where you could go and live in, if there's a house that maybe just has sort of like maybe that extra rumpus room or sort of laundry where it's easy to convert, then it wouldn't be cost too much to sort of bring that house up and convert it from a 3x1 to a 4x2, and then potentially add extreme value in the process. So we're thinking of two plays. It's going to do well because it's close to really lovely suburbs like Edithvale, Aspendale, the kind of on that Bayside sort of line. But then there's also that good gap in median price between 3 and 4, which shows a bit of potential for value add.
Right. Okay. So this comes back to you're seeing this gap in the market, not necessarily the gap between the area next door is worth a lot and this area isn't, even though it sounds like there's potentially a bit of that going on. It's more about a discrepancy in the actual asset itself, or the assets themselves.
Yeah, exactly. It's a desirable place to live. Yeah, and you've got Patterson Lakes with the canals and some pretty decent prices there. So all in all, it's a great area, and I think it'll do well in the long run.
Beautiful, man. So I think I may have skipped over a few more of the stats though. So we're looking at around the 1 million sort of mark as a median. We're looking at 3.2% for a yield, which is actually a surprisingly decent yield for that kind of a property.
Yeah.
Or that kind of a price point, I should say. Now, owner occ. I'm not going to guess anymore because I got it wrong last time. But
yeah, no. So it's quite strong. It's like 61%.
Damn, I should have guessed.
Yeah. No, you should have done. Vacancy rate's quite low, 1.05.
1.05. Okay.
And the rent growth, it's fairly decent, 12.48%. The capital growth has actually gone down over the last 12 months, so it's down 5%.
5%.
Yes.
Not 0.5.
Not 0.5, 5%.
All right, and I know you don't have a crystal ball, but what is it? Just the sentiment, the price point, what are you thinking?
It's a good question. I just think it's going to be the sentiment and everything, and it's happened there. But to me, what that says is like, when we're just talking about the value add, and you've got price down here, there might be a little bit more pain in the future here, but I think there's potential now to get in at a decent price to what it's been. So
100%. This really is all coming back to a greedy when others are fearful, fearful when others are greedy.
Yeah, it is. And I know there's an aspect to sort of looking at property prices where you kind of look for an uptick in the day to get into a suburb. But what I've seen previously, if we go back to, again, there was a time around the GFC 2008 where Sydney prices dropped off, and that premium end, I'm thinking likes of Mossman, really good suburbs, they actually did drop off 10 to 20% just in that period after COVID, GFC. Not, you know, all doom and gloom there, but
you're just getting your doom and glooms mixed up.
Yeah, I did. Yeah, doom. Yeah, I don't know which is worse actually. Probably the GFC actually, but there was an opportunity for people to get pretty good bargains, and then after I think it was only 9 months, you're back to all-time highs. And so I'm not going to say that's happened here, but don't be fearful. Like, if prices are off, it just means there's good buying opportunities, is the way I see it. It's just, again, property's a long-term game. We're not looking to sort of, you know, make, obviously it's nice for 200,000-300,000 like in a couple of years, but if we think 10 years and there's value add that you can add now, then I think it's all very compelling to actually get in and look at this. And I'd put in Bomb Beach as well with Chelsea. I think they're both pretty good areas.
Was that a little bonus area you just quickly snuck in?
Yeah, just a quick one. Yeah. And
the way I've always looked at this is, it's like if you were to walk down the mall and see big sale signs in all of the windows of the shops, and if you were wanting to buy the things that shop sold, wouldn't you be happy about that? You wouldn't be like, oh, damn, it's cheaper. Oh, no, well, maybe it's going to be even cheaper tomorrow. You'd be like, nah, sweet. This is a good deal.
Yeah.
Like, it's an understanding that, again, like you said, it's not going to be like that forever. When this kind of stuff has happened in the past, generally there's a correction in the right direction that we want it to go to. And it's about being that person that if you can hold on and go, and again, the yield is the hardest thing to hold on to right now with Melbourne. Yeah. But whether that's going to happen in a few months or a few years, it's
compelling. It's something to look into. I mean, we're not talking about in the middle of nowhere. We're talking about sort of Melbourne Bayside premium, you know, and if we go back just to look at, say, stocks or whatever, and look at ETFs on, say, the ASX 200, you know, when there's a dip or whatever, or they take COVID, for example, when there was quite a significant dip of about 20%, that's a good time to get in and buy the ETF. And it doesn't make, you know, the fact that the companies in that sort of ETF are any worse than they are. It's just negative sentiment. Mr. Market's put the price down, and I think Mr. Market's, you know, there's obviously fundamentals at play with house market, but the price is depressed. All it means is that there's good buying opportunities. I
remember when all that happened with COVID. And I really wanted to put more money into the markets because I'm not a share guy. I'm a property guy through and through. But I remember looking at it and thinking exactly that, going, I don't need to know anything about shares right now. They've gone down by 40%, 50% in some cases. Yeah. But I had all my money tied up in a reno project at the time, which is I still did wonderfully out of. So I'm not complaining.
Exactly.
But again, it was just about looking at that opportunity and being like, this is time to get in.
Yeah, it's that contrarian play. So when you do see those prices, no one knows when it's going to come back. And yeah, again, not to derail the discussion, but with the GFC, the prices obviously went down for a long time, and they were depressed for a fairly long time. You had the debt crisis as well, but eventually, like when you look at, if you'd have been brave or greedy when others were fearful, to your comment a second ago from Warren Buffett, you'd have done very well.
I was going to say, it's not mine. That's the big buff man.
Yeah, so it's 10-year time horizon, 2008 to 2018. Look at the Microsoft stock in that time.
Yeah.
Let's hope the same thing with Chelsea.
Now, before we get into the no-go list, which again is going to be a bit of a shocker for some people, but it'll make sense, what is our final value add on the million plus list?
One that's talked about a lot, and you always think it should do better than it is, but it's Footscray in the west of Melbourne.
Okay, tell me more about Footscray, quick stats.
So Footscray is about 6 k's west of Melbourne. It has a decent rental yield of 3.21, in fact, %, which is...
you say 6 k's?
Yeah, 6 k's.
So we're real close.
Yeah, we are.
All right, so you could walk into town if you wanted.
Yeah,
it's a bit of a walk, but you still do it.
Yeah, no, indeed. You know, I used to run that back in the day. When I had some hair and I was a bit fitter.
What are you talking about? You and I were in the gym this morning. You're smashing it out, mate.
There you go. You're very kind.
So 6 k's in, and so what are we talking about for a median house price again?
So median house price here is around that mid-9s.
Mid-9s.
Yeah.
Mid-9s.
I know. Yeah. Yeah, it's always been, there's always been a a big disparity with Footscray as opposed to its contemporaries around or in the same sort of proximity, say east of Melbourne. And so there's always been a little bit of a discount, it seems.
Is there like a local stigma? Is there a power plant in the middle of it? What's going on?
Well, it's quite an industrial sort of area, but it's close to that Williamstown sort of area further south. There's quite a few nice areas, and they've got a much higher price than this. But yeah, it's always been a bit of an anomaly to me why it's so cheap.
Yeah.
If around, circa $1 million is cheap, but we're starting to get to this sort of play.
Well, and relatively, like, I don't want to sound pretentious, like, $1 million home, that's so cheap. But like 6Ks from Melbourne CBD, $1 million, and that's the median. So that suggests that you could potentially get something in the 8s or 9s, maybe if you were happy to roll up your sleeve.
Yes.
Sleeves. I'm guessing you got 2 sleeves, not just one.
Yeah.
Like, that's real cheap.
Yeah. Well, maybe in the 9s, but it is. It's incredible value, I think, and it's got that train line in there. There's quite a bit of infrastructure spend. We can talk about that in a second, but yeah, there's a lot going for it.
100%, man. All right, what are we talking about yields? I'm assuming that's going to be one of the deal killers here.
So yield is 3.21%. The vacancy rate is a little bit higher in this suburb, so 2.92. So it's actually quite high.
2.9%. Okay, so that's high. What's going on?
Yeah, it is high, but I think there's an issue with the data here. It's actually mixing in units as well as houses. If you look at realestate.com, there's only 25 houses, I think, for rent at the moment in the suburb.
Right. Okay. So 2.9%. That's not really just houses. We're talking about the whole pack. And is there a pretty oversupply issue of units at the moment in Footscray, or
there is at the moment. There's a lot of stock in the market. So also it's sort of like stock on market sort of number here. That's why we haven't talked about it as well. It's just quite high for Footscray, but that's mainly made up of units. Here we're looking at the investment thesis for houses in Footscray.
Gotcha. Okay. All right. And what are we talking about for rental growth?
So yeah, this is a little bit lower. So it's 9.42%.
9.42%. And capital growth?
So capital growth in the area has been 7.12.
7.12.
Yeah.
All right. So not as much capital growth. Actually, no, wait, other way around. Heaps more capital growth, not as much rental growth.
Yeah, exactly. So again, when I was looking at Footscray, and this was in the, around that 2011, 2012 mark, I'd say that it was about 600,000-700,000. Then.
Yeah, okay.
So it still hasn't grown that much if you think about it in that time. So talking 12 years or so. Yeah, so close to the CBD, you've got the tram development upgrade, you've got the station upgrade as a rail upgrade as well. You've got the airport line from the airport. So there's a lot of infrastructure projects planned for the area, and we should see Footscray do well as time goes through.
Was that giant rail upgrade we've mentioned a couple of times on the show? $60 billion or something like that, and it's like one of the largest infrastructure projects Melbourne's ever done.
It is, and there's been a bit of talk, obviously, about the Melbourne the state government and how much money they've gotten and whether they're going broke. So it'll be interesting to see how that goes on. It's outside of the scope for this particular call, but yeah, there's quite a bit of infrastructure in the works here. But again, like if we just look at Footscray, just going back to the value proposition, it's just 6Ks the other way. I think would be Toorak, and obviously you don't want to compare Toorak and Footscray, but it's such a massive gap between the two prices. It's phenomenal.
It reminds me in Adelaide of actually, and it's even the same name, but it's Toorak Gardens. Toorak Gardens and Mile End, they're probably roughly the same kind of distance.
Yeah.
But it's like Toorak Gardens, you're spending $3-4 million, whereas Mile End, you're spending sort of $1.5 million. But it used to be more like you were spending $2 million in Toorak Gardens, and you were spending like $400,000 a mile. Like there was like this huge disparity. Mile End's never going to be Toorak Gardens in Adelaide.
Yeah. But
the disparity that has begun to close. Like you could start seeing the value. Like it's, I can walk to work. It's like 2Ks.
Yeah, 100%. I'm certainly not comparing Footscray to Toorak as well. I mean, apples and oranges. But again, that's such a big disparity, and it should do well as time goes on. As I said, further south, we've got some lovely areas like said, and Williamstown, etc. So.
It's one of the things I like about the way that you do things, Steve, is I feel like you've got this real mixture between the data side of things. You've got the runs on the board, both from building your own portfolio, but also quite literally making like millions with a team in the investment banking world. But then you've got this logical side to you as well, which isn't sometimes easy to quantify, but it's just like, this just makes sense. And I kind of like that. I think sometimes that's missed a little bit in investing.
Yeah, thanks for that. I think it doesn't need to be rocket science. There's more data than ever. There's more information out there than ever. But generally, as we've talked about again, like few times, like it's taking action and buying areas which just looks like a no-brainer to me here. And just, I mean, it just goes back to some of those core principles of it, kind of in the books, where just buy within that sort of 10K ring of the CBD and you'll do well in the long run. That's worked very well in Brisbane and Perth recently, and I think particularly Footscray will continue to do well sort of as we into the next 10 years.
Yeah, and that I'm assuming now we've got that same kind of disparity between bottom end and top end, the same way that we did when we were talking about Chelsea.
Yeah, you've got that disparity as well between three and four bedders. You know, there's a lot of scope to add value there. So, you know, maybe sort of take a lead from your book, Todd. Get in there, start renovating, and add some value, and create sweat equity, and use the organic growth into the long run to do very well in that area.
Gives you something to do on the weekend if you get bored as well.
Yeah, for me, I'll project manage that. I'll leave that renovating to you. I'm no good. I can change a light bulb.
Mate, and speaking of no good, we're on the no-go. Okay, now I think you've got a few in the booklet, but for here, we're just unpacking one on a no-go list. Now, the reason this was so, I want to say shocking, was because, well, it's going to make sense. Let's just go through our first picks, Werribee and Broadmeadows for our $500,000 picks. Steve, can you tell me what your no-go list is?
I'm going Werribee South.
And this is why I had to do a double take when you told me beforehand. How is Werribee on your go list and Werribee South is on your no-go list?
Yeah, no, I mean, it's a hard, let me just add straight up, like it's a hard one to find areas in Melbourne which don't have good value play here. But if we look at Werribee South, so obviously very close to Werribee, Werribee, as discussed earlier, trying to get as close to the station, look at land, etc. Werribee South has had a lot of house and land development, and there's a lot of green fields out that way. If we look at the median price for Werribee South, 857,000.
Wow, that's a jump.
It's a big jump from Werribee. Yeah.
Yeah. Okay. And is that all the more reason why Werribee's really representing better value as well? The same kind of play that you're talking about with the capital choices. Well,
yeah. And as I said, we're looking at house and land on smaller plots. I mean, yeah, nice houses, don't get me wrong, but lots of development there, and just that bigger, higher price. So while it probably will do not awful in the long run, there's much better places to go about. And I think what I wanted to use Werribee South was just as a bit of a general theme, sort of like no-go areas, because I do. Obviously, the whole point of this podcast is looking at good suburbs and highlighting the value play. That it's there's better places to invest in, and I didn't want to tar just Werribee South. And anyone from Werribee South listening, I'm not knocking the areas. I suppose I am to some degree, but also other areas that that have that big land component had a bit of growth in house and land prices a few years ago. So, likes up in north, like Mickleham, similar areas like there, Tarnett, etc. Whereby again knock out the supply pretty quickly, and I just think that'll, like when you're seeing prices around that sort of 860 mark, and I think house and land packages you can find the odd development around that 600 mark. It just sticks out like a sore thumb that you're not going to see elevated capital growth in the long term. Let's
talk about some of the numbers on this one.
Sure.
What are you talking about for yield and vacancy rates?
So I mean, it looks pretty decent. Like, so the rental yield's 3.7. I mean, the numbers work quite well there, and there's actually been good rental growth there for 22% over the last 12 months.
And what about the capital growth?
Capital growth is -3%.
Okay, so we're going -3%. And now I don't want to say like, oh, there's proof, because we've also got other areas where in Melbourne where it hasn't gone that well.
No.
But so you're essentially looking at this going, okay, so it already hasn't done well, but there's a whole lot around it basically suggesting that we're going to have even more infill. We're going to have more stock coming into the market, which is then essentially going to put the supply-demand ratio away from an investor's advantage.
Yeah. No, I mean, there are a lot of good things going for it. I mean, the rental growth has been good. There's quite a high owner-occupier sort of ratio there, but it's really just that price point and just the supply coming onto the market. It's kind of where it does, and it's buyer beware basically. Like, while the numbers don't look too bad, it's, are you going to get that long-term capital growth, and it's capital growth which makes you wealthy in property.
All right, mate. So wrapping things up, we're looking at, for our yield play, around that sort of 500,000 mark. We're looking at Werribee or Broadmeadows, about 16 k's away from the city for Broadmeadows, 29 k's for Werribee. Now we're looking for our capital growth play, $800,000-900,000. We're looking into Heidelberg West or Reservoir. Reservoir is 12 k's, Heidelberg West 12 k's, so it's a pretty kind of similar distance to the city, surrounded by a lot of areas that are priced well above where these guys are, which is around that kind of 800,000 mark.
Yeah.
For our value add play, we're looking at Chelsea and Footscray. Footscray, crazy close to the city, 6 kilometres out, around that sort of 950 a million mark. If you're getting a renovator, possibly there looks like huge scope there, because you're talking about a massive difference between 3-bedders and 4-bedders, which again, when projects are done correctly that way, you can be setting yourself up for life with the kind of capital uplift you get.
Yeah, exactly.
So Chelsea and Footscray, and as far as our no-go is concerned, Werribee South. And it sounds like this isn't like if you bought there, that would be the worst thing of your life, but there is so many better options to choose from right now if you were to invest in Melbourne. But why stack the deck against you?
Yeah, so many better options. And again, in the report we've been compiling, there's other suburbs in there. And we've talked about a few just in passing on this. But again, why go to somewhere when you've got these other great options to go at and add value, subdivide, etc. So many strategies you can do in Melbourne at the moment and do well.
What's an action step, Steve? Someone's got inspired by this. They're thinking, yep, okay, I might be ready for Melbourne. What's something they can pull out the headphones right now and put into practice straight away?
We were talking a second ago about taking action. We're taking action, just going out to your broker, going out and seeing if there's a bit of equity you can squeeze that borrowing capacity there. Looking at your portfolio, if you've got the deck heavily stacked in Brisbane, Perth, Adelaide, and no Melbourne exposure, then I think it's worth for sure having Melbourne in there just to have that, because as I said, I think it'll be one of the better performing areas obviously over the next 10 years. So just see if there's capacity out there. Look at what your strategy and what you're trying to do. Are you looking for sort of like a cash flow play we were just talking about? Mm-hmm. Are you looking for a project you can get your teeth into? Is it something you want to set and forget? Work out what you want to do there. You can work with your strategist or whatever, or if you are the strategist, work out what you want to do, and then just get out there and start sort of like
just do
on realestate.com.
Yep.
Call the agents, sort of see if there's any good stock out there off market or what's coming to auction. Be mindful of certain areas in Melbourne and some sort of housing commission areas and look for the better pockets close to infrastructure, good close to train stations. Look at zoning. And then just have a quick look at that FISO. What makes sense? How much is it going to cost you? Because we do know the yields are a little bit less. And once you've got that all ready to go, take action. Buy somewhere.
I feel like I asked for an action step and I got an action list. But either
Sorry.
You're right, mate. But I've just summarised here. Talk to your broker, then make sure that you're putting together a plan. Talk to agents, run your FISOs. But basically, it all comes back to just do it. Take action, jump in, make the right moves, talk to the right people, and actually make it happen.
Exactly. And that list has probably come from those protein drinks you've been feeding me.
Oh, mate. Well, look, speaking of food, I'm getting a little bit hungry anyway. I think you and I got to go out and get some dinner. Yeah. But I need to ask you, I've asked you this once before, and I need to ask you again. Steve Ash, what is your favourite pizza?
Oh, God. So the last time I gave you sort of 150 or is it 250 gram in Noosaville, I'd still go there. We were actually there last week and it was just fantastic. Had the Parma there. That's amazing.
What, Parma pizza? Or you mean just the Parmy?
Yeah. No, not the Parmy. It's the actual. I've got the Parma ham pizza.
That Parmy. So you're getting a Parmy pizza?
They call it the Parmy, but it's really just Parma ham on the pizza.
Oh, I'm thinking of like a chicken schnitty with like the sauce.
That does sound good though.
Yeah.
That does sound good.
I didn't even eat chicken and I'd go for that. That sounds good.
Yeah, but I don't want to. I've already given it 2 plugs. But then my son actually did have, like, we were in Miss Moneypenny's in Noosa, and he had like the margarita pizza there, and that was lovely.
Miss Moneypenny's.
Yeah, that's a great little place. My wife loves it. There's pretty good cocktails there, and it keeps her happy. It's just right near Noosa Beach, so.
I'm always happy to give a good pizza shop a shout out. So Miss Moneypenny's in Noosa Beach.
Yeah.
Love it.
I think they do quite fine dining, but they got a great little pizza. outlet there, and they're beautiful.
Well, why don't we go and try and find a place that does a palmy pizza now? Because I think
chicken pizza, yeah. Or maybe get chicken parmigiano on some bread. That sounds even good to me. Maybe we'll just come up with a new idea for a recipe.
Steve Ash, it is always a pleasure having you on the show. Thank you so much for putting together so much effort in this list, because I know that you've been working on this for a little bit and then sharing it with everyone as well. So again, click the link below if you want to get your hands on a copy of it. But Steve Ash, thank you so much for your time, mate.
Thanks, Todd. Thanks for having me. And everyone have a good day.